Okay, well, welcome everyone. I'm Leslie Jouflas. I'm the founder of Trading Live Online. As my slide here says, I've got over 25 years of experience. I'm a chartered market technician. The designation is CMT for that, and that really is the gold standard for technical analysts around the globe. What I focus on and what I'm an expert in is pattern recognition. And I use these specific patterns to analyze markets. And I do use some other classic technical analysis techniques as well. I use very few indicators, but that the ones that I use are very valuable to me. You might be familiar with a book that I wrote with Larry Pesavento. Is called Trade What You See, How to Profit from Pattern Recognition. And Larry was the one who introduced the Fibonacci ratios combined with many of these patterns. We're going to focus today on a pattern called AB equal CD pattern. This is also the basis for what's called the Gartley pattern, which is a retest of a recent higher low pattern. It contains the ABCD. And we're also going to look at the butterfly pattern, which is an extension variation of the AB equals CD. And the butterfly patterns are known as reversal patterns. And I'm going to show you some live charts with those. So let me, first of all, we're going to do a quick overview of the ABCD pattern. So if you don't know this, you'll at least have an idea of what we're going to be looking at on the charts. So over on the left, this is the ABCD buy pattern. This is really a lightning bolt shape to the pattern. And then on the right side is the AB equals CD sell pattern. Notice the buy pattern is coming down. You're buying as the market is descending, and the ABCD sell pattern, you're selling as the market is climbing. Okay, now let's get into just a little bit more detail with this. So this pattern forms with three legs. AB is the first leg, the BC is the retracement leg, and then the final leg is the CD. We can use Fibonacci ratios, and I will show you the ones that I use with this structure. There's some variations to this CD leg. If you look down here at the bottom right, you'll see in blue, there are actually three completion points. The D at 1.0 is when the AB and CD are equal lengths. The D at 127 is when the CD leg extends by the ratio, Fib ratio of 1.27. And that's simply taking the length of AB, multiplying that number, whatever market you're in, by 1.27. You would then subtract it from your C point, and that would give you the ratio. And the other completion area that I use, the variation is the D at 1.618. So just remember that this leg can extend, and about 60% of the time, it's going to be longer than the AB leg. Now, the other thing that we're going to be looking at today on my live charts is what I call harmonics, and I work with these quite a bit. And they're not scary things; they're not super complicated. I am not a mathematician. I know we've got some fine technicians here giving presentations that are mathematicians, and they're just fantastic in their work. Me, however, math was always a subject for me that was not at the top of my list. So believe me, if I can learn these and use these in my work, you can do it too. So don't let it scare you off. So this is an example here of harmonic swings in what would be an A to B leg, and then here's a retracement leg, and then a C to D leg. Now notice here that this swing from high to low is 23.75 points. And this swing down is 22.75. These are almost exact within a point. And then notice these upswings here, those are also within a 1.5. So the markets tend to repeat the same size swings. And then we also get into market environments. We're in right now a market environment of expansion. So the markets are either contracting or expanding. That's all they do. They go up, they go down, they go sideways. That's all they do. You just have to learn to recognize when you're in one phase and then the footprints of when you are most likely coming out of one phase into the next phase. Okay, so simple harmonics here. We're looking for kind of equal length swings and maybe some extensions of those, and I'll show you some examples on the live charts. So here we go. Here is an example of repetitive swings, harmonic swings that form the ABCD trading patterns. Now, these kinds of swings form any kind of trading pattern in technical analysis. You have to have some type of swing to do it. So here we have two equal length swings, and then our B to C retracement leg. Look at this. This is also made up of two equal length swings. So that is not unusual at all to see. Okay, I'm going to fast forward some slides here. Hang on just a second to the next set I want to cover before we move on to the live charts. Okay, so here's the Fibonacci ratios that I use. This is what my Fibonacci ladder looks like. So I use the 0.382, 0.50, 0.618, 0.786, and 0.886. And I know a lot of people who don't use Fibonacci, they say, well, sooner or later you'll hit one of them. Well, that's true. That is true. But you have to, if you have some other structure like these patterns, then it just sort of is another tool to use. I don't use Fibonacci ratios in and of themselves. I use them as a tool with the specific patterns that I use. So here you can see on the left side, it's an example, a line drawing example of an ABCD cell pattern that possibly would retrace to a 0.618 and then continue up to complete at either the D1.0, D127, or D1618. And same thing on the buy pattern on the right. So there's our lightning bolt shapes on both of those patterns. Now this ratio here, the 0.886 ratio, this is the square root of the 0.786, which is a pretty commonly used fib ratio for most people that use fibs. But the 886 is what I call the last chance fib retracement. The reason is that over my years of doing technical analysis, working with these patterns and working with these ratios, when the market, this is the last chance for the market to come up and do a test and then either turn or continue up. My observation has been that when the market gets up to the 886 ratio, when it has a close above that 886, has a very high chance of getting at least to the 1.0 and most often above that 1.0. So same thing like down here, if the market retraces down to an 886 retracement and it gets a close below that, most likely it's going to get down to that last swing low, and most often it will get below it. Now, what's interesting also about this ratio is a lot of traders, well, they might now after I put it out there enough, don't use this ratio. So a lot of them are using only the 786. And so a lot of times what happens is stops are placed below that 786 with no idea that this little guy is sitting there, and the stops are hit. They get a wash and rinse. That 886 holds it and the market reverses. So you might want to put this on your own charts and see if you find those two things I mentioned about that ratio to be true. And I would just also like to mention, I'm a huge believer in it. You have to learn a method for yourself and not rely on anybody else. I know right now, because the decline in the market, a lot of traders want to know what's going to happen. They're feeling nervous, but you've got to get yourself to a point where this type of market environment does not at all make you feel nervous, and you know what you are going to do. And that's what I help traders do. I believe in teaching you how to fish, not coming. You very rarely know what my positions are. It's not important. What's important is that you learn how to do this and you create your roadmap. Okay, let's move on to one more slide here. So with the ABCD, this is an example of labeling the pattern, and labeling the pattern is an important first step when you're learning these. It's going to help your eye recognize the pattern when you get to the stage that you start to see them forming in real time. And you can also see the symmetry of the pattern. So if you notice the A, B, and C, they form a triangle. And then the B, C, and D also form a triangle. And you can see how symmetrical this illustration is. And this is what we want to kind of be looking for with the patterns. Sometimes there's asymmetrical patterns. And I'm going to show you a little trick for that when we get to the live charts of something that you can watch in the time symmetry that's helpful when you're looking at an asymmetrical CD leg. So for now, just concentrate on that lightning bolt shape and learning some of those fib ratios with it. And I always say you just draw lots and lots and lots of charts. Okay, just a couple more charts here. Now, with this pattern structure, the C point, this is important, the C point cannot exceed the A point, whether it's a buy or a sell. So this is an example of a double top. And even though it was very close on this particular pattern, that C did not exceed it. And so it is still a valid ABCD pattern. So this is just a step one. I think we just went over that. Let me see if there's something else that I want to make sure to show you. Some of these slides are from one of the very lengthy courses, a 12-hour course I have on this trading method. We'll get into that in the end if there's time. Okay, so you can just sort of study these. When you guys get the videos, you can pause these and study these. So here in this slide, again, this is just a little recap of how you find those extension links. And so you can study that as well. Okay, that was the last slide on that. We'll come back to these courses if we have time at the end. If not, I'll email out to everybody about these courses. All right, so let me see if I can now get from here. Oh, I think I did it, to live charts. Okay, here we go. Okay, so we've got about 30, 35, 40, 40-ish minutes or so, 35 minutes. So what I want to focus on today is I want to focus on, first of all, the patterns that were prominent at the highs. I've done some other presentations. I do some presentations for stock charts a couple of times a month on one of their programs called Your Daily 5. And I usually do that 2 times or 3 times a month. And for January 11th, you know, I put up my segment was on these patterns that were nearing either just completed or nearing completion. So let's walk through the indexes. We're going to go through the NASDAQ, and we're going to look at the Dow Jones Industrials using the mini contract. We're going to look at the S&P, and we're going to take a quick look at the triple Qs and the Russell. So I have various time frames here. Combining time frames is an important skill to learn in trading. And so I've been looking recently at some of the longer term weekly and monthly charts, and we're going to take a look at some of those. So let me start up here with the NASDAQ. This one over in the right-hand corner. So there's been a succession of patterns on the NASDAQ, and there have been buy patterns. Here's an A, B, C, D buy pattern, and those they're A, B, C, D over here. But there have been a succession of sell patterns since last fall, especially of the butterfly sell pattern. If you remember, I just mentioned that's known as a reversal pattern. In my experience over more than 2 decades now, over 25 years of doing this and working with these patterns, I know like the back of my hand when you start seeing a succession of these butterfly patterns, whether they're buy patterns or sell patterns, especially sell patterns, because market tops are more of a process and market bottoms can form with kind of V spike type patterns. So when you start to see a succession of these patterns and you see them across the indexes, and then you start to see them on individual charts and ETFs or stocks, you've got to pay attention to that. So we can see here, there was a butterfly sell here. So the butterfly sell, we're going to draw one out so you can see what it is a little more clearly, is notice this X point here. Well, the X point is what starts a butterfly pattern, and it's an A, B, C, D pattern where the D leg, the completion, extends above or below the previous swing before that A point. Okay, so here we have one here, we have one here, there was one here. This one just got a little teeny retracement and then moved back up, and then we got this is actually a 1, 2, 3 drive pattern. Then there was an ABCD buy pattern up to this final leg of the NASDAQ. And here's where the NASDAQ started not leading any longer. Now the Dow Jones started to finally come up to new highs. We're going to look at that chart because there were some problems with those new highs. And so the NASDAQ formed a range. It had an A, B, C, D pattern, couldn't get above that last high. Now, when I'm using ranges, I'm always looking for where the center line is, because that center line of those ranges is sort of like a home for prices. Prices are going to come back and test around that center, and eventually it's going to have a strong move away from that center in one direction or the other and break out of the range. So that's what the NASDAQ did. You can see where that dash center line is. You can see how then it came up and made another high and then came back down here, and then, you know, tested it right here, came back down, tested it here, back up, tested around here, back down, up through it. Here was a clue, this long bar with no support at that center line. It had a kind of a skid through this lower trend line. On my weekly market setup, so I do this analysis and we look for setups with these patterns and I post them on the videos, send them out to the subscribers. I had said that when this happened, I had said that you know, this did not get a close below this lower trend line. However, this test here, if this comes back down and closes below that trend line, we're likely to see a much stronger move to the downside. And that's just using simple classic technical analysis and many years of observation. So now we're getting this move to the downside here. So for us, you know, watching this pattern develop, it was not a surprise to see this type of move to the downside. Some of the simple indicators I use were also showing kind of negative. So on the NASDAQ also, let's go to this daily chart. And we can see here, now we clearly have this trend line break, this little bit longer trend line coming from last fall, following along here, parallel channel really breaking to the downside. So now any rallies back up towards here, we're probably going to be setting up some short opportunities. I want to make sure I click the right place on this chart so I don't lose it. I do that sometimes accidentally. I click the close instead of the collapse. then I spend the rest of the day trying to get it back. Okay. Now let's take a look. I'm going to move this over a little bit. I think I've got my NASDAQ charts I wanted to show. Okay. So now let's take a look at the Dow Jones Industrial. And I said this was having problems up here at these highs. And let's take a look at this chart and I'll show you the reasons why. So when the NASDAQ was leading, the Dow Jones could not make new highs. Back here, the NASDAQ was leading strongly. The Dow was having problems. Here was the previous high here. It came up, came back down, up, back down. See the range that it formed? See this area here, that dashed line? I always put that in as a dashed line because that way I remember that's the center line. But look at all the trading it did around that price level. And then it came up and it made this new high, A, B, C, D, extended, butterfly cell right here. Another interesting thing is right down here where these green lines are, is this was a kind of inverse head and shoulder. And again, this is on our weekly market. So that's, we were following this pattern. So if we, break out above here, probably going to get up to some new highs. Here's a measured target for it. And that's, exactly where, the price came. And then it collapsed. Here's a little ABCD buy pattern retesting these previous highs, but it totally failed and got just a teensy little retracement up, and then wham, look at these long bars down. So now the market comes back up and it forms this really beautiful butterfly cell pattern. So we have our X here and we have our A, B, C, and D. And here you can just see what the ratios were of the retracements and so on. After following that, there's a bearish candle signal, but however, these don't give any kinds of targets. But you can see the here, once the market tried to rally back up and couldn't make another high, it just sort of fell out of bed. Well, now today, interesting. So here we've got from this low of the butterfly pattern to the high, this extension down to this 127 is just about where we found support. This lower horizontal trend line I have drawn in is this support from last June. This is where we've found some support today. So you have to watch this low in the Dow. You can draw this trend line in, go find that low from June and just extend it across. So if we break this, we're going to see more lower prices. My feeling is that we will see lower prices. We're just getting a bit of a breather here. I mean, look at these bars to the downside, except for, a little bit of a pause here. We've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, like 11 hard days to the downside. So it needs a little bit of a breather. This is also for you Elliott wave aficionados, a 1, a 2, and this is a wave 3 right here. Now let's go. So this gives you sort of an overview, a bit of a roadmap. So we might get some retracement back up here. Gives you a little bit of a roadmap. Now let's look at a monthly chart. Okay, so all the way back, here's our 2020 lows. Now, one thing that I've noticed on these charts is that we have not seen even, a 382 retracement from this extraordinary move to the upside from those March 2020 lows. So here's a couple of areas that I'm going to be keeping an eye on. Remember, we never know what price is going to do. You don't know. Nobody knows what price is going to do. All we can do is use some technical analysis skills and monitor the market. I like to use support resistance levels. I add, some fib retracements, kind of tie some other things in. But here we can see this is where a breakout to the upside was in late 2020. See the long bar coming up. So a lot of buyers came into the market and were able to push the Dow to new all-time highs right here. So that's coinciding with this 382 retracement. Now, even if it skids a bit, this 0.50, and we might see some support come into this area. But we're looking at some very bearish candles here. Notice on here, notice as it got up here, notice these doji candles starting to form. So that means your open and closes are starting to get to the same area. Here we have a close and we have an open in the same area. This close not that far away, this open and this close almost the same. And then here we have, you know, kind of an outside day here where this high was above here. That's a kind of a breakout type of a setup. So this is what I call sort of a dynamite setup. This is a form of the market coiling, and coils form or a form of energy. I've been saying this for as long as I've been doing technical analysis. One of the first things I ever observed, and then I started reading about it formally, you know, in a lot of classic technical analysis books. And when you start to see markets coiling, it's going to come out one direction or the other. Okay, I'm going to take a quick look before we get to the S&P because I have quite a few charts here. So we've taken a look at the NASDAQ, we've taken a look at the Dow. Now let's take a look at the Qs. Lots of people follow the Qs. Very similar, of course, to the NASDAQ. Formed a range. Notice the center line, same types of patterns. See the butterfly pattern. Here we have A, B, C, D buy pattern. The market made the final high. Here was an A, B, C, D buy pattern, the lower end of this range with the retracement back up again. And it stayed in this range, coiling, storing energy. It's going to explode out of one end or the other. Here again, we see the center part where the market spent a lot of time around that price level, that 390-ish price level. It broke, it had a little fake move to the downside, made everybody think that it's coming back up again, right up to the center line. And then it just was, you know, history once it came back down below that trend line. So I think that the NASDAQ right now is there were a lot of stocks in the NASDAQ that had a lot of air in them. So we're letting out a lot of air out of the tires. So I think that this might be a little bit before we see that come back. And the other one I want to look at real quickly is the Russell. Kind of the same type of pattern, but a longer look. How much longer? This coiled for almost the entire year of 2021. I found that so interesting. We started watching this on our the weekly market setups video way back here because this was not following the NASDAQ. This had stayed in this very large range. And the Russell is on the bellwether for small caps of US stocks. And so it's important to watch this. It can sometimes, a lot of people look at it as an indicator of economic health. And so this was certainly kind of saying something, I think, early on. Had a false breakout to the upside and then back testing, and then broke out here to the downside. Now, I think any retest back up towards the lower end here, you got some little tails down here, or even if it managed to get back up above this, then I think this center trend line would be a place to look for a potential shorting opportunity. Okay, so now let's get to the S&P. This is a market that I trade frequently, and we do a lot of analysis on this every week in our weekly market setups. And I train a lot of traders in the S&P 500. So I think it's a great market for trading, no problem with liquidity. And now it's got the micro So it's a great market to learn, because you don't have to risk a lot when you get to live trading, which should be a process, and you don't just start there. Okay, but here it's talking about some harmonics. This is a parallel channel that have been following for a very, very long time. And it's done a really tremendous job with these extended trend lines that have been on here for a long time, of finding the highs and lows, the support and the resistance areas. So harmonic moves. So here's some harmonic moves. So back here, January of, what year are we? 2021, you see this move here to the downside. Well, here, everywhere you see a pink line here, you can see this is the similar type move here. Here, with the little green on the end, all that means is that it extended by the 127. Remember how we did that with the ABCD pattern? Well, you can do that with this as well. And so I like to follow, what were the last size moves that the market made. And a lot of times you're going to find that these are repeating those lengths of move. So if you think about it, if the market only does contraction and expansion phases, then you can start to really understand how these moves repeat. And when they're like a little shorter, that like this one here and this one's a little bit shorter, it's usually going to be like maybe a 0.618 or 786. It's going to be a fib ratio of that last move, and same with the expansions. They'll be like 127, 1.618, sometimes they'll be 2.0. And very large market moves like we're having now, they're going to be an expansion of larger ratios. So over here, this is our butterfly pattern. I'm going to show you on a 60-minute chart. I'm going to draw it in for you so that you can see how I did that. And right now, this lower trend line is what I'd said in our weekly market setup, said this test up here, this lower trend line had been broken. Some support was found here. Said, if this turns around from here and breaks, this trend line doesn't hold this lower dash pink, then we're in for a larger move to the downside. So this is something that I keep on my charts, and I try not to hit the X instead of the collapse, so I don't lose this chart. I'm sure I can find it again. Sometimes they just disappear. Okay, so this gives us an overall view, looks at some harmonics. So let's go, let's see, where do we want to go next? Oh, let's go over here. First of all, I'm going to show you, this is using the SPX instead of the futures. So here is this section here is where the butterfly sell pattern was. Well, these are patterns that you can find well in advance, and that's by watching the swings. So here, let me draw this in. So here's the X point where I'm starting right here. There was a leg to the downside, and here's a retracement to the upside, retracement to the downside. Remember, when the D, we can find that D point well in advance. When that extends beyond our X point A, B, C, D, then we know we have a butterfly pattern. Now, you can start to monitor these. Like here we have this X swing, we have this A to B. When this comes down and holds support without exceeding that A, remember that's one of our criteria, then and turns up or down if it's reversed, then that's when you can start to monitor that as a potential pattern. Now here, because we can extend our D point early, even as soon as these bars turn up, we can start to monitor this as a pattern. Then you can draw this in and find out where those price points are, and then you can plan, whatever you need to be planning in advance. So I just want to show you on that chart that that's how we draw them out. So here it is. So December 23rd is when we first identified this. So it was right, right about here on this bar here. We monitored this pattern and it had the completion point here. And then following this first drop right here, where this bullish candle was, this first large candle down, it had said that, many times when you have a very long, wide range candle, either direction, the market will retrace back up to about 50%. The entire candle, if it's a down candle like this, is resistance, but many times right around that halfway point of that candle. And so that's right where the market retraced to. There were intraday little ABCD sell patterns coming into here that gave signals to go short. This candle in of itself, this very bullish candle, it took a lot of bullishness to push his price from this low and close it, not quite at the highs. That would be even more bullish. But obviously a lot of bulls came in here. So that makes the lows of this candle, I'm going to put my horizontal cursor on so you can see that. That then makes that a very important support area to watch and to monitor. If it breaks it, if you do breakout trades, that could be a breakout trade. If you see some little sell pattern intraday before it, that can be used and monitor that. So there's just some very simple techniques that I use. Okay, oh, here is another butterfly pattern right here. X, then A, B, C, very extended. D on that, did not get much on that, and then formed the big one. So remember what I said, when you start seeing a lot of these, pay attention. They're not all going to all work. They're not all going to get this type of a move. But when you start seeing them across all the indexes, markets, and other things, then you got to be thinking, this could be a fairly large one. Okay, now here's the other thing I wanted to show you. When this has to do with the symmetry that I mentioned, the time symmetry, and I show you a trick on this. So scaling down to a 60-minute chart, this is a detail of the butterfly cell pattern that we looked at. Hang on just a second, let me check my time real quick. Okay, we're doing okay. Okay, so the AB leg, all I did here was from point A to B, all I did was took a vertical line and I just drew it down from where the B ended, and I drew it straight down. And then I went to the start of the A, and I just drew a horizontal line to meet that vertical line. And this just represents time, how much time it took for the A and B leg to form and complete. Now, what you can do sometimes when your CD leg is kind of asymmetrical, the slope, notice the slope and angle right here is steeper than this whole slope and angle right here to form that entire AB leg. That's much steeper. Sometimes the market needs a little more time to fill out, and sometimes it'll do it by extending to 127 or 1618. But sometimes what you can do is clone that, just move it over. There's your time that it took the AB leg. So sometimes, they'll complete right there, but we can also use some fib ratios with our time analysis. Move that up so we can see it a little better. So here, I'm just going to put the fib ruler across that time representation. So that's represents right here to the 0, the same amount of time is here to here. And here's the 127. So you see that fib ratio come into play with time, and that's where the market started to turn from. Sometimes they'll turn from the 1.0, but if you have a steep slope and angle, sometimes traders will panic out, it's not doing anything. But if you know a few little tips and tricks to look for, sometimes it'll help you keep from shaking out of your trade. So here's something if you're going to study these. You might want to screenshot that. That's okay. Just don't put it in your own PowerPoint and see you out there teaching with it. Just use it for educational purposes. Okay, so we covered that. We covered the analysis of this. Now let's take a look at, sorry, okay, we did that one. Okay, now let's go and let's take a look at where some potential areas. Now markets get to do whatever they want to do. They're the markets. We cannot force the markets to go the direction we want them to go. We can't force them to stop where we think they're going to stop. When a book that I wrote with Larry, Trade What You See, How to Profit from Pattern Recognition, the first part of that, Trade What You See, came from a saying that Larry always said, still says, trade what you see, not what you believe. So try not to get too far ahead of yourself. Just monitor the levels that you're watching. Okay, so with that in mind, let's take a look at a couple of potential things. So I'm going all the way back here to 2000. So this was the bear market of 2000. Here was the bear market of 2007 to 2009. Notice the big, enormous range. Remember, coil, just think dynamite. That's all you need to do is think dynamite when you have a big coil like this. So all I did was I took the height of, the price decline from here, and then I cloned it and dropped it over here, and they're almost the same. Now, does that mean we get almost the same here? I don't know. But it's certainly an area that we can watch. So the red dashed line, I just dropped it right over here. So I'm going to keep it on this chart and I'm going to monitor the price. I don't trade off of weekly charts this is a monthly chart. I don't trade off a monthly chart. So here, when it got close down to this area, I would be scaling down to my intraday charts. Now here is where our 2020 bear market, very fast bear market was. So this purple line, I cloned that and dropped it over here. And that gives a potential projection if we're in for a larger correction. Now, the other thing I want to show you is that we can see if we can let's tie in maybe some fib retracements. Let's see if we can find anything with that. I don't know, but all I'm going to do is look. So here we can see that the larger correction from 2020, we can see that was close to a 5.50 retracement from that 2020 low. So I'm just going to remove that. I don't want to clutter the chart too much. I might come back to it in just a second. But let's look at a couple other places we can do some retracements. Well, a couple places that I like to look is where moves started. And I see a couple on the chart here. One is right back here after the 2013 breakout. And then it had a little correction down here. This was actually an A, B, C, D on a monthly chart. So let's see if we can. So that's 382 retracement. That's tying in a little bit more with this. And remember, we can sometimes see multiples of these swings. So if we bring this down, maybe down here. Now, what does this tie into? This 5.0 ties into where the breakout to the upside was from 2020. I found that with very severe corrections, the price will go to an important historic level. And as we can see, they can get there really quickly. So it's a good idea to have a few areas sort of mapped out in advance. Again, we don't know if they're going to get there, but we can certainly find some areas to monitor. And same thing with the upside. Find your resistance areas. I just showed you some ranges and some center lines. I do some work like that. The other place I see for retracement is here. And this is the 2013 upside breakout. Sometimes instead of going down to the lowest point, which you can do, but also look at, again, where these breakout moves occurred. Get on there. That's pretty close. These 382s are pretty close. Doing a double of this correction, this one here from the 2000 and 2007 bear markets, and we're just doubling that line. That's coming down to this 0.50, which is pretty close to retesting that area. So there's just a few things for you to look at to help you analyze the charts. Again, it's most important for you to, learn techniques that like the back of your hand. You're never going to get where you want to be trading unless you learn how to do it yourself. Following somebody else's calls and only following those calls, it's just doing it blindly, and it's really a random fashion. You have to completely remove randomness out of your trading. You'll never get anywhere with it. So what I'm seeing, just to summarize here, is on our monthly. Our month is not closed yet. Oh, just a sec. Let me go back to one more thing here. Nope, not that one. Hang on just a sec. I'm sure there's a weekly in here somewhere. Ah, here it is. Oh, and that's why I had the yellow circle, so I could remember. Okay, so the weekly chart of the S&P, this is what I wanted to show you as well. Hang on just a sec. Okay, so here's where a butterfly high was. We see that even on the weekly chart. We can see there's a butterfly there. But again, look at where the open, close, we'll move to the downside, back up, look at the close, open, close. Look at the open on here was the same as the close here, and then, struggled, gets the upside. Here is your, on a longer term chart, that really looks like the keg of dynamite powder to me. So today, the market looks like we may have found a little bit of support today. My expectation is that we're going to come back up and test some areas, but I think, still in an environment of selling the rallies, and the rallies in this type of market condition, they can be very convincing and they can be very swift to the upside. A lot of times they will occur in the opening part of the trading day, and maybe the first 30 minutes or an hour, maybe even into 2 hours if it's kind of gotten going a little bit. So it really convinces you the market's turned around, and then before you know it, it just totally falls out of bed. So let's use a couple fib retracements here. Oh, I know. Over here, this is our 2020. Here's our 2020 decline. That's the pink line. And so I just cloned it and dropped it in over here. And we can see, if you look at my red horizontal cursor, it's again retesting an area where the market had a lot of buying come into it. It ranged and then broke out to the upside to new highs. So if we get that steep of a decline, this would certainly be an area to be watching. But I think back to the upside, again, here we are on the weekly chart. And so here we have a very long bearish candle. So about the halfway mark, I'm just going to eyeball it. You guys can measure it out. I'm just going to eyeball it. I think right about there. Somewhere around the 4,500-ish area. I don't want to make it an absolute price. Let's make it a zone. Maybe if we get a strong enough rally over the next couple days, a few days, if we don't break below this 382 strongly, might get a rally back up. And let's see from high to low. I don't know if this is the low before a good rally, 44, but that would bring it up to about the 0.5 to 4520, 0.50 area. So let's keep an eye on that and see what happens. Now, if we decline further, then we're gonna have to change the analysis. I'm still gonna watch this area, but I don't know what the bars yet would look like to the downside. So I'm gonna remove this real quick. And notice here, all this clustering, you know, I don't know where we're gonna close today, but we may close above these lows here too. And that would then make this a support area to watch. We sort of skidded past it today. So let's see where this closes. We have this big gap to close. Just getting up to this gap may offer a very short opportunity as well. We may even form a nice ABCD sell pattern to the upside. So I'm definitely gonna be watching for some nice patterns to be forming. So I just want to get back real quick, and I want to tell you about this course. If you're interested, again, you've got to find something that resonates with you. Just keep looking until you come across something in one of these presentations and you go, wow, that is very cool. I just want to spend hours and hours and hours learning this, because that's what you have to do trading. There's no easy way. It's this, there is not an easy crash course in trading. You have to have a real passion and a desire to learn it. And there's a lot of steps. Again, I've been doing this a long time, teaching traders for a very long time. I put together, it took me a long time. I put together this 12-hour step-by-step course. The very beginning, you start with harmonics, with Fibonacci ratios. You start building into the patterns. If you do not have the pattern recognition, no matter what you're trading, if you do not have a strong foundation in that, you're going to have problems trading, because you're not going to be identifying the correct setups. Then the other thing that's super important that a lot of traders lack is they lack a trading plan, and you must have a trading plan. If you do not have a written trading plan that you can follow, you have no way to assess what you're doing. And if you cannot assess what you're doing, you are doing, this should be a 4-letter word, but you're doing random trading. And if you're doing random trading, just kicking the tires here and there, throwing darts, you're going to be a hamster on one of those little hamster wheels forever. You're going to have times where you're going to do okay. You're going to have times you do awful. You have to have something that you can follow with consistency. And this is what builds the confidence in your trading. And trust me, I worked with traders for so many years. I know the things that trip traders up. In fact, I'm really looking forward to the presentation May 24th. I just jumped on it because I'm like, it's psychology, discipline. I don't believe in discipline, by the way, in trading, but I'll explain that more May 24th. And time management. I thought, oh, let me sink my teeth into a presentation for that. But anyway, this course, Mastering Pattern Recognition, this is 12 hours, step-by-step. After all of the pattern structure, and lots of exercises to do, make sure you have it. Then you're going to go into learning how to put together a written trade plan. Don't be scared. It's not as hard as you think. And also trade management and how to assess how you are doing. You have to have some way to find out how you make money and how you lose money in trading. And then I'm also, for the special here, I decided to add in at no additional cost this 8-hour course of the seminar that I recorded in 2009, which was a historic volatility period. And it's a very relevant course, and it's generally $349. The special is not available on my website. This is all of the things all of the different segments in the 12-hour course. This is where we start. We go through. My master chart tips is after every single section. I go to my live charts, just like we did today, and show you, important things about what you just learned. And then here's the trade management. It's the engine that fuels the patterns. The patterns mean nothing without trade management. All right, so you have to understand the trade management and your risk, and then you get some free stuff with it down here. And then the 3-day self-study seminar recorded in historic 2009. I am really proud of this seminar, and there's a lot of extremely useful information on here. So I'm combining those together. I'm taking the 12-hour course is only $697. I'm taking $50 off of that. So $647, and including this 3-day self-study that I recorded in 2009. So that's it. I made it under 55 minutes. And that's it. If there were any questions, David, for me, please let me know what they are, and I'm happy to answer. Or come to my website, Trading Live Online, and you can find a contact there. You can email me from there as well. And I'm going to email out the link for these courses. You can't get the special price from my website. You'll have to get it from the follow-up email that I'll send you. Okay, now I'm done.
This was, earlier in the presentation, someone asked to explain more about the money flow index indicator.
Well, the money flow really just tells you if money is flowing in or out of the market. And if you look back on some of those charts, you put a money flow indicator onto your charts, you'll see that there started to be divergences with those patterns where money was flowing out of the major indexes. Get a handle on the major indexes, then scale down to your ETFs and individual stocks, etc. So yeah, money flow was definitely diverging, and it was showing negative, and on balance volume also was.
Oh, okay, yeah. I think that's about it for questions. So.
Okay,
right.
well,
all right.
thank
Well,
you very much.
Thanks for being here. Yeah,
Thank
great
you very
presentation.
much. Thank you. Have a great day, everyone. Bye-bye.